Good afternoon, dear subscribers of my YouTube channel. Today I would like to talk to you about a very interesting and important topic, the topic of refinancing. When we talk about this topic, of course, there are a lot of different opinions. Some people believe that it should be done in certain situations. Some people think that it's always a bad idea. And there is never a straightforward answer. When people ask me if it makes sense to do an RRSP, I say, well, depending on your situation, maybe it does, maybe it doesn't. Same goes for free savings. But to one person I'll say yes, to another I'll say no. There is no straightforward answer, so it all depends on the situation. But at the moment, I see this in the situations with my clients, so a lot of clients are having financial problems. Some are afraid they might lose their jobs. Some are going through a renewal right now, and their rate is changing, let's say, from 1.7% to 4%. Some have gotten themselves into a debt hole, having used their credit cards too much. People are in a tough financial situation. But they have one option to get out of this situation and do what's called refinancing. But refinancing is a double-edged sword. On one hand, it can help you if you do everything right. On the other hand, you end up back at the starting point, so to speak. Back to the situation when you first got your mortgage. In this video, I will explain how to refinance properly. To help you get rid of your debts so you can start breathing normally again, so to speak. But what's even more important is how to get you back to your original amortization schedule, so that it doesn't turn out that yes, it helped you now, but it sets you back for the next 10 years. No, we'll make it so that refinancing helps you today, but thanks to the concept I'll explain at the end of this video, we'll get things back on track. So, without any further delay, let's discuss this important and complicated topic. There are different reasons why we recommend refinancing. One of the most common, for example, is when someone wants to buy a second property, because I believe there's no better investment than real estate. Just think about it. You're buying a second home, you're using other people's money, not your own, you're taking out a mortgage for this property. If you have the all-in-one program, it's just perfect. That means the down payment isn't even yours either. You're basically borrowing it from the bank as well. You buy a property, a stranger moves into this property, your tenant, who rents your apartment, and this person pays off your mortgage over the next 25 years. After 25 years, most likely the price of this house has doubled, maybe even tripled. You no longer have a mortgage on it. If you decide to sell this house, you get half. The profit is not taxed because of what's called capital gain. The second reason is the interest rate. Many clients have a high interest rate. And if you, of course, are with banks that have low penalties, then it also makes sense to break your mortgage and get you a better rate. To do this, you need to call us and we'll see how feasible it is. Because if you got your mortgage with RBC, TD or Scotiabank, unfortunately this option isn't possible since the penalty there is high. The next reason is that some clients decide to change their jobs. Today, for example, they work for someone else and decide to start their own business. When you start your own business, doors close for you. Getting mortgages or loans becomes impossible for the next 2 years. And for many clients who start their own business, this can become a lifelong issue. So, what do I advise such clients? To do a refinancing and set things up so they have access to money at any time without needing to show income or expenses. A very convenient program, again all-in-one, where you do this once and in the future you can access these funds at any time, repay at any time. And thanks to this concept, you can pay back the money 2 to 3 times faster. This is for people who are planning to become self-employed. I also recommend doing refinancing before you decide to start your own business. The next factor, which is actually the most important factor in today's video, is if you've fallen into a debt trap. If, for example, you have credit card debt, car loans, a line of credit, or something else. In this situation, it's very hard to get out on your own because the interest rates, especially on credit cards, are astronomical. Usually 20 to 25%, and in some cases even 28%. In this situation, it definitely makes sense to do a refinance first, because on your own, you most likely won't even be able to get out of this debt trap. The next reason we often do a refinance is if a client has decided to make some changes to their home. Maybe to add an extension, build a garage, or simply update their home and do some renovations. In this situation, it also makes sense to do a refinance. If you are planning, for example, to buy another house but you don't qualify, maybe because you started your own business, there's nothing worse for us than when a client starts their own business. Because on paper, you all look very poor. In reality, things might be going great for you, but your accountant writes everything off, and on paper you don't qualify for a mortgage. And that's why often a client would like to buy another house, but they're not able to. But in this situation, instead of selling your house and buying another one, maybe it makes sense to do a renovation. There's another reason to stay in this house, which is also common when we advise clients to refinance, when a client is planning, say, to move to another house. But houses have become much more expensive, and they don't qualify. Even if they sell their house for more than, of course, what they bought it for, because prices in Canada are not rising in all regions. At the moment, there are 2 regions where prices are dropping dramatically. But in general, there is no such thing as a Canadian market in Canada. In Canada, there are regional real estate markets. That's why you need to talk to your realtor, and they will tell you for sure whether it makes sense or not, whether it makes sense. But often there are situations where the client simply can't find anything better because everything has become very expensive. Well, in that case, it also makes sense to renovate your home. Maybe add something to it, maybe build a garage or something else instead of buying and selling. Because when you buy and sell, of course, you have a lot of expenses associated with the transaction. But if you do a refinancing, then aside from needing to get your home appraised and maybe pay for some mortgage registration, you don't have any additional expenses. And another topic is the so-called cash flow. Very often clients find themselves in a situation where the monthly payment is just so high that they can't afford to pay it. If this is a constant situation, then it's dangerous, because it's only a matter of time before you lose your home. But if it's some kind of, let's say, unexpected situation, maybe health problems, you couldn't work, maybe you lost your job, then of course, refinancing will play a huge role. But you need to do it in time. If you've already lost your job, if you've already started having some problems, then unfortunately we won't be able to help you anymore, because banks are not interested in clients who already have financial problems at the moment. You need to take care of this in advance. Now, I'd like to show you an example where a person was able to lower their monthly payment thanks to refinancing. And at the end of the video, I'll explain how to return again to the original amortization. Now, I'd like to walk you through an example that a huge number of our clients find themselves in. Well, not just our clients. If you're not our client yet, I hope you'll become one. We work all across the country, so no matter where you are, no matter which province you're in, we can always help you. I'd like to show you this scenario using an example where someone is in a difficult financial situation and how we can help them today, as well as how we'll make sure to return their mortgage to the original amortization in the future. Let's take an example. Let's say Ivan and Marina bought a house for $500,000. Over 5 years, the price of the house increased to $600,000. At the moment, the remaining mortgage they have is $400,000. The interest rate they're getting now is 4.29%. At the time, they had received 2%. 5 years have passed, and now the mortgage is up for renewal, and many clients will find themselves in this situation in 2026 to 2027. And of course, this will be noticeable in the monthly payment. The monthly payment will increase dramatically. Well, just imagine, you were paying $1.99 and now you'll be paying $4.25. These clients have 20 years left on their amortization. With an interest rate of 4.29, their monthly payment is $2,477.39. But these clients also have additional expenses. They have credit cards totaling $20,000, on which they pay $600 a month. I calculated $600, just as 3% as a monthly payment. It's not much, but I had to put down some amount. Let's say, in this situation, the client has to pay $600. And you understand that the interest rates on credit cards are huge. 25%, sometimes even higher. That's why this person won't be able to pay off these credit cards quickly. But besides that, they also have a line of credit for $25,000. Or let's say a car loan, you could call it that too. And where they pay $750 a month. That's an increased monthly payment for the mortgage, plus credit cards, plus $25,000. The line of credit, of course, hit these clients very hard. Their monthly payment is now $3,827.39. Now, I'd like to show you the scenario I would suggest to this client. The initial situation, of course, is the same. The house price is $600,000. But the mortgage, $446,832 is the original mortgage, or the remaining mortgage balance, while the client had $400,000. Why are the amounts higher on this side now? Because we took the loans he had, let's say $20,000 on a credit card and $25,000. Line of credit. I added it to the mortgage. Why is it higher than $445,000? Because when you refinance, you have additional expenses. They are roughly around $1,500. You need to do a home appraisal, register the mortgage, and so on. The interest rate, I set it higher. Because again, if you're just doing a renewal, or if you're buying a home, you can get a slightly better rate. But if you're refinancing, your rate is a bit higher, because for the bank, well, it's a slightly higher risk than if you were just buying a home. 30-year amortization. I can already hear people saying, most likely, well, obviously 30 years amortization. Of course, it will be easier for me. but I'll have to pay for 30 years. Watch this video until the end, I'll explain everything to you. Okay? The important thing right now is to save you. You are in a difficult financial situation. The monthly payment is huge. You might not be able to handle it. You'll get even deeper into credit cards. And eventually, you'll end up in such a debt spiral that I won't be able to help you anymore. The important thing right now is to save you. And a bit later in this video, I'll explain what we're going to do next. 30-year amortization, monthly payment of $2,250. Instead of $2,477, you see it's already cheaper. It just works out that way. But now you have no credit card payments at all. And you have no expenses related, say, to your car or to your line of credit. So in total, your new monthly payment is $2,550. The difference between the situation you would have without refinancing and the situation you'll have after refinancing is $1,577. I don't know how well or badly you're doing, but if you explain to people who are in a tough financial situation that they can reduce their monthly payment and improve their cash flow by $1,577, that's a huge amount of money. This is the first part of refinancing. It's important for me that you understand, if you don't refinance, you will most likely fall deeper and deeper into debt and maybe even someday lose your home. If you refinance for a short term, I have made your life much easier. And now, I'll explain to you what to do next. When things get a little easier for you, when your situation improves. Maybe, I don't know, your salary has increased or the problems you were facing hopefully have ended. And of course, it's very important that you absolutely do not start using credit cards again and fall back into the debt trap. We helped you, we saved you, and now it's important to get back on track. And now we come to the most interesting part. After your situation has improved a bit, I hope it does, because with refinancing, you no longer have large expenses from credit cards or even a car loan. Of course, it's very important that you absolutely do not start abusing credit cards again. Credit cards are the most dangerous business you can imagine for us, the consumers, and the most profitable business for the bank. After the new year, I will be starting a new series where I will explain how to use credit cards properly and even how to make money with credit cards. But in this game, there are two very important factors. And one of them is the one I'm already telling you about now. You must not abuse credit cards. Just because we've gotten rid of them, gotten rid of your debts, doesn't mean you should start using them again. Otherwise, you can't keep refinancing forever. Someday, you'll run out, even in the equity of your building or the house you live in, for example. Now I want to show you how we will return to the original amortization. Because you had a 20-year amortization, and now I'm giving you 30 years. I hope things have gotten better for you, and now let's bring the amortization back to 20 years. First of all, I'd like to show you why refinancing is not advantageous. Because if you look at the screen, you'll see two lines there. The blue one is the principal repayment on your mortgage. This orange or brown line represents the interest. When you first get a mortgage, a large portion of your monthly payment goes toward interest. And only a small portion goes toward the principal. But over time, as your mortgage balance decreases, the interest portion gets smaller each time, while the principal repayment increases. And let's say you have 20 years of amortization left, as in the situation we're describing now, then you're getting close to the point where half of your monthly payment goes toward interest and half goes toward principal repayment. And if you refinance and set the amortization to 30 years, you go back to the starting point again. You start paying as if you just took out the mortgage. And instead of, say, after 20 years when things start to look better and more of your money goes toward paying off the mortgage and less goes to the bank, then you go back to the starting position and you end up paying a huge amount to the bank again and only a small amount toward paying off your mortgage. That's why it's important to make sure we return to the original amortization schedule. And now here's the most interesting part. This calculator you see on the screen is from the FileLogic program. FileLogic is a program that connects us with banks and credit unions. We send your information, your credit history, through this program to these banks. And if the banks trust this program and this information, then you can really trust these calculations. I want to show you here. This is a mortgage, a new mortgage plus an additional loan. The interest rate was 4.49%. We set it up for 30 years, amortization. The monthly payment was $2,250. If the client says, from the money he was able to save, if you remember, I showed you, it was $1,570 a month, I think, the person is better off. Cash flow. If he says, what if he is able to put an extra $600 from that money towards the mortgage? Pay attention to what will happen. If you add $600 to your monthly payment, instead of a 30-year amortization, you get 20 years. Amortization. In order to return to the original amortization you had at the beginning, you need to make those $600 payments. If you say, actually, I can put in all the money I saved there, those $1,570, then that's perfect. You'll pay off your mortgage even faster. But for me, it was important to show that if after your situation improves, you are at least able to pay $600 more, not the full $1,570, just $600, then you already return to the original amortization. And what is also very important, note that if you can return to the original amortization, you will save $130,000. That's a huge amount of money. That's why this factor was very important to me. I wanted to show and prove to you that in a short-term situation, while you have problems, you need to refinance. But as soon as your situation improves, you need to increase your monthly payment by at least $600. But ideally, at some point, you should reach the level where you can add all the money you've saved to your monthly payment. I hope that in this video, I have dispelled some myths and shown you the real situation. In what situations does it make sense to refinance? If you had to do it, and I'm by no means saying you should do it just because you want to go on vacation 2 to 3 times more per year. No. If we are refinancing, there is a reason for it. As I have already explained, you want to start your own business, you want to innovate, or maybe you want to buy an additional house. Or you are in a difficult financial situation. But if we have done this refinancing, it's important to take the following steps. If you work with us, you don't have to worry about anything. We will take care of it. And we will make sure the refinancing is done properly and in the right place. And we'll make sure to return you to your original amortization as soon as it's possible for your financial situation. That's all for now. If you like this video, I'm sure you'll enjoy the other videos as well. Follow me. On social media, there will be a very interesting segment related to credit cards. Of course, it concerns everyone, whether your finances are great or not so great. For business clients as well, it will be very beneficial to watch and learn how you can make money with credit cards. With that, I say goodbye to you. I wish you all the very best, God's blessings, and good health. Until next time in the virtual world.
This is Victor Schiefer. We invite you to please fill out the comprehensive form available on our official website, which is vsolutions.ca. You can also readily contact us by telephone at the number 1-877-282-0904, or alternatively, you may send us an email directly at safe@vsolutions.ca. We encourage you to truly enjoy your life today, and we will diligently work to create a successful and prosperous tomorrow for you.